All right. Hello, everybody, and welcome to another live event here over on Pepperstone's channel on YouTube. Today is a great topic because, of course, we're talking about something that we're going back on, which is candlesticks. I'm really excited to bring this topic because there are some advanced techniques for candlesticks. It's often what we first learned about, the candlestick patterns, candlesticks in general. Most people only use candlesticks charts, don't they, Tyrone? But it all comes down to bringing this together with some advanced techniques. My name's Thomas Atkinson. As always, I'm joined by Tyrone Abella. How have you been this week, Ty?
Yeah, good, Tom. Yeah, look, candlesticks are one of our favorite topics as they unlock the secrets to price action. You can't have price action analysis without candlesticks, of course. And we're going to delve into some advanced techniques tonight to really actually utilize what price is trying to tell you, because it is a big key to understanding the market and learning, I guess, how to trade the best way you can.
Just before we get started today, of course, we'll be covering quite a few topics. We'll be looking at how to identify and interpret complex candlestick patterns accurately, enhancing our day trading and scalping strategies. We'll be having a look at understanding of advanced and candlestick analysis and, of course, enabling that into some decision making. And, of course, by the end of the session, we should have some equipment. We'll be going into some live session stuff at the end as well, so make sure to stick around for that. And if you have questions, feel free to ask them throughout today's live session. So we always get asked a similar question, and it comes back to what is the ultimate candlestick pattern? Well, today we need to talk about a trio of patterns, Ty. The top three patterns unraveled, which is the best, which ones do banks sometimes use, and we see in reports, and of course, which is our favorite candlestick pattern. So how do we look at it? Well, this is the one that most people come and they learn about. It is probably the most common, I would say, in terms of candlestick patterns, as the hammer and the shooting star candle. Ty, did we learn about this pretty much as our first candle? I feel like we did.
They were very first and foremost in our trading journey. And look, they're actually underutilized. A lot of people don't realize the power of these two candles actually. And I think when you do understand what they're trying to tell you, especially when you can isolate them at particular parts of the market, they are very, very powerful because they tell you a lot about what the market's doing. You do get your big tag name candle patterns, but a hammer and a shooting star are definitely one of the most popular and definitely one of the most useful.
Yeah, so let's go through what a hammer and a shooting star actually are. But Ty, do you want to explain why these are the most popular? What's so special about the wicks on these?
Absolutely. Look, the wicks are actually what make the candles so unique. What you can see here, obviously the open and the close make up the body of every candle. So you can see here, we've got the open and the close marked with two red arrows. What that's really telling us is where the market actually opened and where it closed. The wick is telling us what actually happened throughout that session or throughout that period. Now, it doesn't matter whether it's a 15-minute chart or a 1-hour chart or a weekly chart. That candle represents that particular period. And what the open and close is telling us is that although they close very close to each other, so the closes are very close to where the open was, there was an extraordinary amount of market action that actually went the other way, and that battle was lost. So in the instance of the hammer, you can see that we've got the open and we've got a close very similar to the area where it opened, but you can see that the market was pushed down very, very heavily and created this big wick. So what that's telling us is that the sellers made a big attempt to actually short this market, and it completely reversed. And in the end, the buyers had control. Now you can look at the colors, and all the green and the red is telling us really is that the close was actually lower than the open in the red, but really they're telling us the same thing. The wick is where the information is here. We had a big sell-off, and the buyers came in and took all of that momentum away and basically brought the market straight back up to where it actually opened. So it's telling us a lot about what the market is doing, because the sellers definitely lost that war.
Yeah, so I always say wicks hold orders, Ty, and I think that's a big concept. Remember, from a beginner, you would say, okay, well, there was a war. It went down, it came back up. Obviously, the buyers ended up showing some commitment here, and it may mean that if we get a new higher high, we are going to continue on forth. And these actually have some statistical relevance. I'm not sure exactly the percentage, but it certainly is a little bit better than a coin flip, I believe, in markets. And that builds on our base of a strategy. Of course, if you start taking a little bit of edge and then stack that with confluence storylines, it can be an advanced technique. But remember this, advanced technique, wicks hold orders. So the second candlestick pattern that is incredibly popular has to be the bullish and bearish engulfing patterns. Now, these are, again, something we all learn about when we first get in, but often underutilized, great confluence techniques, aren't they, Ty, with other methods. So bullish and bearish engulfing techniques, why are these so important?
Most definitely, because these are telling us a momentum shift in the market is basically imminent. You can see here in the bullish engulfing example, you can see that we've got a weakening market where we've got 3 or 4 candles coming down in a row, selling off, and then all of a sudden we've got a big green candle that completely engulfs the body of the previous candle. That's telling us that although the market did initially try to sell off, it was completely reversed by the buyers, and it completely reversed to the tune of completely engulfing the previous candle. That says a lot about the buyer momentum, because generally speaking, these candles are found at very key points in the market. And when you see a big engulfing candle like this example here, which is effectively what an engulfing candle is, it's showing a big momentum shift in what was a predominantly selling market to a buying market, and in a bearish engulfing example, what was a buying market into a selling market. And yeah, quite often at the key levels, these patterns very rarely fail.
Yeah, so when stacked with evidence, they can be a really good technique. So I think from an advanced concept, the bullish and bearish engulfing, they're not maybe so special in any point in area, but what about if we stack them with a supply or demand or a support or a
Most
resistance
definitely.
level or anything else? They're very, very powerful, aren't they? And highly
Yep.
utilized by a lot of traders out there. Then we go to the third one, probably my favorite actually, which is the long leg doji candle. Now, there are a few here on the chart, Ty, and I'll take over for a second and go through this one because I do love myself some dojis. And what a doji is it's basically an open and a close at a very similar price. Basically, you can see here we've broken it down to a percentage. And we like to look at it as around 20% of the candle should only be the body. And generally, you want it to be relatively in the middle. Now, what that means is that market has gone to a high point and it's gone to a low point during whatever that time period is, whether that's a 15-minute, 1 hour, daily, etc. And an advanced technique would be obviously the dojis mean a lot on daily, weekly, and monthlies, because that means that for all of that trading period, let's say a day, that's 24 hours, a week, that's obviously a whole 5 and a bit days of trade time. That is basically an exceptionally large amount of time for the market to have gone high, the market to have gone low, and then closed at the same level. I like to call it equilibrium. So the market has found a point that it is very happy with, and it's very content in staying there. Basically, we could see it as fair value for the current market condition. And that's why a popular strategy is that if the doji is broken either the high or the low, then we usually get a breakout, as in like that breakout has effectively occurred, and we're moving to what we call the next level of fair value or equilibrium. Now, dojis also hold orders. So this is a big thing. Because we know a ton of transactions may have gone through this area, there's some kind of, I guess you would say good technical analysis history to say that these hold orders. I always have a bit of a quiz, and this is for you to pause the video and maybe put in the comments down below. Which one holds more orders? So here is a example, and basically we have two kind of long leg dojis. Which one has more volume in it? Well, the answer is we don't know by looking at the size of the candle. What we do know, though, is that they're both long leg dojis. And obviously, in this one, we have a bit bigger body, but it's not the size of the candle that's important, is it, Ty? It's just the
No.
where it is in position.
Yeah, most definitely. It's very, very important to understand that dojis are an amazing candle, but only in the right area of the market. Like all candle patterns, really, understanding where it is. And look, they can be very, very powerful in, pausing a market, reversing a market from a long to a short or a short to a long. But they have to be in the right place. A doji in the middle of nowhere, Tom, we always say, is a doji not worth looking at.
There you go. That's a good one to go by. Another advanced technique. So often we read reports from big banks, Ty, and they come out, daily. Everybody gets them when you've got like terminals and all these types of things. But which ones do we see often mentioned? And I usually find these in daily reports when people are talking about single stocks. They could be talking even about currencies, commodities, or anything else. You've seen it mentioned a few times as well, I'm sure. Evening stars and morning stars. How often do you think these are considered? And are they one of your favorite patterns?
Yeah, they are one of my favorite patterns, especially on the bigger time frames, because really it's a 3 candle pattern, as you can see, where and the bigger the time frame, the more important the pattern, and that goes for a lot of candles anyway. But as you can see, if we were talking as an example, looking at weekly periods here, let's pretend we're talking about weekly candles. That's a 3-week period on an evening star, where we can see that we've had a big move up. Okay, every one of these candles is represented by a week's worth of trading. We're obviously in an uptrend. Then we've got the evening star. Yeah, what can sometimes look like a shooting star candle at the very top of that pattern. And then we've got effectively a reversal candle that basically looks the same as the previous positive candle. So all of the momentum that was with the green candle on the left has now been taken away on the right, but it has that shooting star separating the two. So it's reached a point in the market where it's found resistance, and now all of a sudden the momentum shift has kicked in and the sellers have completely taken control. And often you do get a little bit of a gap, but when you see this pattern, it can be a very, very strong pattern. I like them a lot because they do represent 3 candles that actually give us a lot more information than just a one candle phenomenon, really. I love to see a little bit more backup in our patterns, and that's what the evening star and the morning star give us. They are very good reversal patterns.
Yes, very good reversal patterns. The end of a trend and the start of a new trend, often considered. And again, with confluence, very, very powerful. The gaps is probably the advanced technique that we would get behind here. So a lot of people ask, where do we use candlestick patterns? Well, of course, all of the standard targets are good. Anything with a lot of liquidity in it and a lot of algorithmic or robotic trade is usually a great place to be. And also where a lot of us, the retail traders, are. So you don't need to get fancy when it comes to candlestick patterns. What you do need to do, though, is trade liquidity. And these are just some examples of liquid stocks or currencies. And these are some examples of course, times that you want to trade. Think about what session you're in. If you're in the Asian session, again, as we always say, trading yen pairs, trading odd pairs, New Zealand pairs, they can be very good in currencies, and Australian markets, Nikkei, etc. for Japan. And then London session, you're going to want to trade the markets relevant for that, and US session relevant for that. So it can be very good to see breaks of these particular candlestick patterns as well, and also to see liquidity steals. So the London session's well known for a good bit of hammering and shooting star, where around the beginning of the session, 30 minutes before, so generally 30 minutes before the session, all the way to around 1.5 hours after the session opens, you'll often see markets push one direction, then reverse, and they'll create, as I said, shooting stars and hammers. So we tend to get the beginning of these particular candles. And remember, wicks hold orders, so it can be quite significant. So what is our favorite candlestick setup, Ty? Which one is your favorite in your opinion? I know you have quite a few, but which would you go with? If you
I do, but if you held a gun to my head, I would be saying that it would be the evening star and the morning star. They're not as common as the other candles. Obviously, you do require a setup of 3 candles to actually make them activate, but their rarity is actually what makes them better, because when they do actually appear, they are generally quite reliable, especially in the right market areas, and they do tell us a lot about what's actually happening in the market. What about yourself, Tom?
Mine's going to be a little bit of a cheat. I'm going to go with the island reversal. So effectively what that is where we go down and we have a gap that goes underneath, and effectively it creates some kind of build position. And then we see a movement to the upside. So realistically, what would happen is we get another gap to the upside, and then that's where we'd go from. Now, I'm not sure if it's still drawing here, Ty, but that's basically the one thing we'd be looking at. So the island reversal is a move down, a gap, then it sits for a few days and either accumulates or distributes, and then it moves in the opposite direction. It's a mixture of candlestick formation, creation, and maybe also a bit of supply and demand.
Nice. Yeah, all very powerful in their own right.
Yes, exactly. All right. Well, we'll move on to the next part here, Ty, and I'll just have to quickly close something, guys, because I think we've frozen, unfortunately. Let's just quickly fix this. Let's see what's
the color
going on
wheel
here.
of
I don't
death.
know. Yeah, it is. It is. I think it's too much memory usage. 1 second, guys. I might just have to fix it. See if I can fix it. Could be anything. Oh, not too good when you're doing this live and it happens. Okay. Just give me 1 second. But nothing. I actually think you might have to take over for a second here, Ty, and I'll have to come back. I do think it's gone, and I'm not getting this one back without a refresh. So can you handle it? I'll see everybody really soon. Sorry, guys.
I can.
Right,
all right. No, I will. No problem.
Right.
Yep. So, okay. So what? Just a little bit more on what the island reversal represents. The island reversal represents a break in the market where a significant move in price has caused an open to be considerably lower than the previous close. And the reason Tom would like that is because it actually is a market reaction to, it can be an event, it can be news, or it can be something just as simple as an open, or sometimes the London Open. It's rare these days, but when liquidity wasn't as strong in the sort of early 2000s, market gaps happened a lot in open. So if you had a London Open, quite often you get a gap event or even New York Open, but that is not as common anymore because the market was so liquid and they're 24/7 markets. They are 24/5.5 markets. So it does take a bit to actually make that happen now. That's the difference, I think. When you actually see an island gap now, it is actually significant because it's rare. And that's why I like the morning star and the evening star patterns, because they are a rare pattern that actually only happens in significant times of the market. And you can actually take advantage of that by, I guess, utilizing the market movement. It's really, really important to understand, though, and I've said it a few times, it's very, very important to only trade them when they're in the right areas. They do need some sort of confirmation. So say, for instance, if you're looking at a morning star pattern or an evening star pattern, you do want them to have some form of support or resistance to back them up, a supply and demand zone, or even a moving average sometimes. Sometimes the 20 moving average can do the job. Those sorts of things build a case to make the candle pattern stronger. It's not as simple as just trading, say, an engulfing pattern in the middle of nowhere, because if you do that, really the market's not giving you the advantage that understanding where the pattern is actually giving you. So as an example, if we've got a market moving up and it's going, so we've got 3 or 4 long leg range bars in a row. So say, for instance, we've got 3 big green candles in a row and we've had a pretty good move. And then all of a sudden we get a doji candle and then we continue on with another 2 or 3 green candles. The doji candle isn't really relevant because it's basically formed in the middle of what is effectively an uptrend. So as soon as that comes up, we're not really reading what the power of the doji is. If that doji happens at a resistance point, so say, for instance, we've got 3 or 4 good strong candles in a row, then the doji candle appears, but we've at a previous point of resistance or a supply and demand zone, that makes a very, very big difference, because that's telling us there is about to be a shift in the market or a potential shift in the market after a big long move. So it does make a very, very big difference. So looks like we're going to have Tom back here in a second. Looks like he's just about back in.
All right, everybody. Sorry about that. Well, now that I'm back, we will be going into our next section. But just before we start that, we'll actually go through a quick disclaimer. We'll see you in just a second, guys. But it's all back and running. See you very soon. Okay, all right. Well, we're ready to go with the next section. So, Ty, candlestick patterns. Cracking the code. How do we use a candlestick pattern and supply and demand trading together? So what are some supply and demand zones? How do they form? How do we even see them in the markets? How can we spot them better? A little bit of a advanced method for spotting good supply and demand zones. A great way of also supplying range-bound markets. Then, of course, what's our favorite candlestick pattern that works with supply and demand? Well, let's begin by discussing the idea of what is supply and demand anyway. We've talked about this a little bit here on the channel, but in general, this is one of the key things. Supply and demand is a mixture of accumulation, distribution, and basically reaccumulation and redistribution. Now, that's what often people know them as. But really what demand is think of it as an area where markets have built a position. And then we know it's demand when it breaks out and above. At that point, we can basically say, okay, we have formed a level of demand. And that means that the orders that were placed here were most likely buys. And that means that if the market comes back down into this zone in the future, we would have to assume that there could be buyers once again. So basically, these are the types of things that you're looking at in these market conditions. Now, in terms of a supply zone, it's the same type of thing, but we can taller the supply as it breaches to the downside. So basically, in this case, we've got a market that's been ranging, and then all of a sudden it's broken to the downside. We now know that the orders that were placed here were most likely sells. So therefore it becomes what we call a supply zone. And if the market comes back into that area in the future, there's a possibility that we'll see a sell. Now, ordinarily, Ty, it looks like this on a chart. You're going to have levels of supply and levels of demands and everything in between. But the problem with all of this is that sometimes trading and technical analysis can be a little bit subjective. How do we make it simpler for us to be able to identify supplies and demands on any time frame that we're looking at, whether it be a 5-minute, 15-minute, 1 day, week, whatever, et cetera, et cetera? Well, it actually comes back to what we all learn at the beginning, which is often, how do we spot supply and demand zones easier? Well, what in essence is a supply and demand zone type? It's kind of like a channeling market, isn't it? It's a range-bound market. That's where it starts from.
It is, and identifying when a market is actually in a range-bound zone is actually very, very important, because if you don't know that you are in a range-bound zone, you could be placing trades that actually don't really play nice with a market that's going sideways, and you could be using the wrong indicators and all sorts of things. So understanding that you are actually in a supply and demand zone is actually very, very important, because not only does it give you the clue that there is a potential breakout to trade, or you might be taking profit into that zone, but it really shows you the right way to trade, because there are ways to trade it. You can actually scalp that sort of a zone.
Well, of course you can. You can scalp. Look, there's always, every type of market condition has the ability for us to profit from it. The question is, what type of trader do you want to be? So if we're going to use supply and demand in general, we are looking usually for markets to be breaking out and then markets to be coming back. So we can use the 1-1-2 method or 2-2 method to really recognize when a market is starting to become range bound and therefore entering into a period of accumulation or distribution, or creation of a supply or demand zone. So in this case, we have the 1, which is the first touch to the top, the 1, which is the second touch to the bottom, or the first touch to the bottom, and we've got the 2 and the 2. Basically, once we've gone 1, 1, 2, 2, at that point, as we head back to the middle, we can effectively say this is the beginning of something that is a channel, and it's either a range-bound market for the foreseeable future, or we're going to see a breach either way that is therefore going to become a supply or a demand. So a great way of doing things is the 1-1-2-2. It'll simplify also when you're using things like moving averages as well. If you're using a moving average on a chart, the problem often is, Ty, when it gets range-bound. So when we have that range-bound period and the markets come down and they start doing this, the moving average is going to start sidewaysing. The problem with that is that then you will get fake crosses all the time, and your cross systems and a lot of other systems will break. So it's very important for us to be able to identify supply, demand, or range-bound markets, isn't it, from that aspect as well?
Absolutely. We call that moving average effect the ribboning effect, where moving averages are effectively ribboning each other. And they become effectively useless in terms of how to trade them at that point. So that's why understanding what market you're in makes a very, very big difference. I'm not... are you getting any crackling on your microphone, Tom? I'm getting a lot of crackling. I'm not sure if people are hearing it.
Yeah. You probably are. It's always the way, guys. 1 second.
There's some gremlins in the system today. Yeah, there is lots of noise.
Yeah, I can fix it, but it's just going to take me a second. You can keep talking, Ty. I'll fix this.
Sure. So supply zones are great, because not only do they give us an opportunity to trade out of a particular market, but they also give us a target to aim for when it does happen. That's why we love them, because when you've identified where they are, when you do get the eventual breakout, you can see that we can get a move down. And then we know what we're looking for when the market moves up. Quite often, the market will retest that zone, because a supply zone is where orders are kept. So quite often, if you are trading down at the bottom, you'll see a move up, and you can have a really good area to place and take profits, and obviously maybe re-enter the market if you are looking to join the existing trend. So, yes, it started when Tom returned. Yeah, no, I've got that. I'm not sure. He's come back as a different person. Yes. So yes, that's what the great thing about supply and demand zones are, is not only are they an area where you can actually enter a trade, but they're an area that you can exit a trade quite comfortably, because they basically, the market gravitates to these zones quite easily. So joining a trend, an existing trend, is a good way to use a supply zone, or taking profit from a counter trend, as you can see in this area here, where the market moves up to the second arrow. Tag that area where a lot of orders are held, and that could be a good place to take profit, or a good place to actually re-enter the market. So they do give you a multiple way of actually using them. It's not just about understanding and trading inside the supply zone. It's also trading around it when they do eventually break out and retest those zones.
All right, so that should be really clear now. I'm sure it is, Ty, correct?
There he is. Yeah, he's back.
Yeah. All right, guys. We're back. There is some kind of gremlin in the system today, unfortunately. So how do we trade the supply and demand zones with candles? Well, simply we can bring in some different candlestick patterns to really identify kind of key reversals. Now, obviously, a very common one is the engulfing candle setup, where we have effectively maybe a movement up in this case of candles, and then all of a sudden we have an engulfing candle that goes the opposite way. Now, if that happens inside of a supply zone, once we already know it's supply and the market's coming back, it's fair to say there were sellers here once before, so there could be sellers again. And the engulfing candle is a very handy candle to be able to use through these particular systems. Another thing you could look for is a shooting star in this case, another confirmation that the markets have made a decision. And this is where we get into confluence storylines when it comes to building a position. So obviously confluence storylines really important. And this is something where we can use candles and supply and demand zones together. So engulfing candles, and I would say also hammers and shooting stars inside of these zones, very, very powerful. But Ty, what other candlestick patterns could we use inside of a supply and a demand trading zones? Like, how can we use this as confluence? What other ones do you think might work?
Yeah, well, depending on which way you're trading, if you're trading the actual supply zone for what it is, small reversals inside the up and down movement are always powerful. So if you have actually isolated your supply zone and you've got the high and the low, basically that gives you a really good opportunity to trade inside that zone. The important thing is understanding that you are actually inside that zone so you can actually apply the right method. And when you are at the top of that supply zone, you can effectively trade long. Short, and when you're at the bottom of it, you can trade long on the scalping mindset until it eventually breaks out. Just because it is going sideways doesn't mean that you can't actually participate. So I think as long as you understand that you're in it, all of the candle patterns that we know and love, like shooting stars, hammers, even morning star, but they're probably a little bit more rare, but morning star and evening stars at these levels. But engulfing patterns are definitely very prominent in supply and demand zones because they are actually just reversing what is a mini basically just a mini area where price is consolidating inside these zones. And until it does break out, there's nothing wrong with using those candle patterns to actually trade from basically one end to the other.
Yeah, nothing wrong with using things like engulfing or shooting stars and hammers at the tops and the bottoms. Also, from the aspect of my favorite kind of candlestick pattern to be used with these, again, I would probably go with the doji. And what I'd be looking at is markets to come back to dojis. Because remember, dojis are something where generally we've seen a lot of orders or a lot of transactions going through. So if you had like a doji and the market came back to a doji, there may be a reaction off that particular doji. You'll find that that's quite a good advanced technique. So charting success, Ty, the lightning bolt, something we talk about quite a lot in terms of being able to create price action based approaches. How do we use some type of lightning bolt strategy that is the movement of price action and candlesticks together? Well, today we'll be taking a look at price action lightning bolts. We'll be having a look at how lightning bolt setups with candlestick patterns. And of course, which is our favorite candlestick pattern for the lightning bolt setup. So Ty, you love this man. No, I love this man. Richard Wyckoff. Successful tape reading, guys, is the study of force. It requires our ability to judge which side has the greatest pulling power, and one must have the courage to go with that side. Now, the reason we like Wyckoff's quote here so much is because he's basically saying we need to spot where the big players are, and we need an early detection system to find out when a big player has made a decision or change. This is where the lightning bolt price action sequence comes into things. And we can use this along with candlestick patterns and candlestick setups to potentially build a scalping or day trading system. So to begin with, we have a series of lower lows and lower highs, don't we, Ty? And then all of a sudden, something changes. What is the significance of what happens down here?
Yeah, what this is really showing us is a change in the momentum and the trend effectively. Once we've got a series of lower highs and lower lows, and then we get an instance where we actually get a new higher high that actually is higher than the previous high, we're getting ourselves a change in trend. The market is telling us that the momentum has shifted from what was effectively a long-term downtrend to what is now a potential uptrend. And once we get that break of that sequence, that is really giving us the momentum shift. And it's all important. That's what really makes the lightning bolt what it is, because the lightning bolt on the way down, obviously, is a series of lower highs and lower lows. And on the way up, it's a series of higher highs and higher lows. But this is the first time that the market actually changes direction and the momentum shifts. So it's really, really important to identify that, not only for actually entering positions, but also potentially taking profits off the table. So if you were short in that trend where you've got a series of lower highs and lower lows, your first warning sign that trend could well be over is the first time it actually breaks past a previous high and actually closes higher. It's a very, very important warning system to let you know that a change is potentially going to happen on the way up and on the way down. So it's a very, very important sequence. And that's price action at its best. Price action is telling us exactly what the market is actually telling us, really. And that is that there's a momentum change. If you don't recognize that, you could end up giving a lot of your profits back. If you stay in that trade, quite often what you're going to see is a big reversal, and a lot of the price that you actually captured on the way down is going to be completely eradicated as the price moves up.
Yeah, so not all price action is, of course, equal when it comes to this. Sometimes, as Tyrone mentioned before, the higher high is probably the key here, or the lower low. So what we've got to be really careful about is that making sure that that is present in these positions, especially when we're scalping and day trading. It's more important when we're scalpers and day traders to be able to realistically be very, very, very key and zoom in and make sure that we're on top of when markets actually have made a significant change. If you're a swing trader, you can afford, because of the higher time frame, to be a little bit less or more relaxed, I guess, with your setup. But when it comes to day trading and scalping, you have to be very accurate. So we're looking for that higher high or lower low, and that's usually the better lightning bolt beginning. So how do we use like a candlestick with this? Well, first we need to understand what the Composite Man was and Wyckoff's concept was. And basically he said that we need to understand that the whole market is potentially a single entity. If we then think of the market as a single entity, whether it's currency, whether it's stocks, whether it's commodities or cryptos, then basically we can use the concept of the Composite Man. And that represents that the biggest players, market makers, banks, etc., allows traders to better understand that they are pushing the market around, and that potential manipulation may manifest in price action. If we go back to this lightning bolt concept, think about what's happening here. It's making a series of lower lows and lower highs. What happens when it makes a lower low is it pushes to a new low. That then instigates people to place shorts. Now, the reason that this is such a powerful technique is when you think about it, a lot of people heard about GameStop and AMC, Ty, and of course they were popular because of the short squeeze. So there was an SS short squeeze, but in this case, what happened actually was the market would often push to new levels where people would then open shorts, and then the market would swiftly change trend by going to the higher high. And when that happens, it probably won't come back to let those people that entered into shorts exit for break even prices. So because it does that, they leave their shorts open, and then they get forced into, quite large negatives. And I'm sure that's happened to many people out there that are watching this video right now. And unfortunately, the way it is that's kind of one of the things that does tend to happen. So of course, Wyckoff warned us. He said, if you see this type of event happening and then you see a reversal, you better be starting to think about who's in control of this market. The lightning bolt is like our first early detection system, isn't it, Ty?
It is, and it was definitely one of the most important, because price action is the first indicator that you're going to get that something is actually happening. Indicators that aren't price are lagging. You've got to remember that. So for the most part, the price action warning system is going to be the first one that's going to give you the biggest clue.
So here's some lightning bolts in action. Here is a recent snapshot of the US 500. So, of course, do they work on indices? Well, yes, they do tend to. So the market's come down. The market's made a low. The market's then made a lower high. So this is a lower high, or just basically we'll call it a high in this case. We've got a low. Then the market goes down and makes a lower low. And then the market comes up. Now, it does do a switch in here, but then it makes a higher high. And upon this higher high, it's a significant change of trend. It's basically a significant breach, which then means that pullbacks could be met by bull demand. And that's what we tend to see here moving forward. We're basically seeing strength from the lightning bolt from the first time frame in terms of what's going on here in a relatively small time frame. Now, if this was a 15-minute chart, would it make any difference? No, it would still be a lightning bolt against the trend, and therefore you would trade it accordingly. One of the advanced techniques that you could use in a system like this would be to approach it from, if you're trading a 2-hour or 15-minute chart, you're going to need to have different take profits. And oftentimes what you're looking for is less points or less pips, isn't it, Ty? You've got to be adaptive to your time frame.
Most definitely. Understanding the time frame that you're in and understanding the expectation of your trade is very, very important. I mean, it goes without saying, I think, but especially with this being, the case, a lot of people find themselves actually probably going for more than the market can give them, Tom. And I think that's probably one of
Yes.
the biggest failings. You have to understand that if you're trading a 2-hour chart or a 15-minute chart, the take profit levels or where the market is likely to head because of the pattern that you're actually identifying is limited to that time frame. Okay, so yes, big trends do start from the smallest time frame and then eventually go. But that's not the way we trade it. We're not looking for a weekly reversal starting with a 15-minute chart. We're looking for what the expectation of what that time frame is going to give us. So it's very important to understand the expectation of the time frame that you're trading.
So here's another example of a euro US dollar. And again, we're seeing kind of like a movement up and it makes a higher high. And then suddenly it goes to the new lower low period. And then we come back up. And the reason I want to bring this chart up is not that it's here in terms of a candlestick pattern on this particular time frame, but what types of candlestick patterns could we use in a situation such as this? As it comes back up into this area, what could we use? Well, the engulfing candlestick pattern, which would look something like this, where we got a green candle kind of coming up, and then all of a sudden we get this big red candle. That would be a fantastic thing to see in this circular box, wouldn't it, here, Ty? It'd be a very, very good sign.
Most definitely. Yeah, no, it's very, very important. And I think that's when it comes, when you paint the story and you bring the pieces all together, it really makes a lot of sense. And when you look at charts like this, like you can see how it is actually retesting this zone. And when you do get that pattern to verify what you're already looking for, in a sense, you already know what you want the market to do at that point. All the candles are giving you is the confirmation that that's actually playing out. So it gives you the confidence to actually get in and actually trade that.
Some examples would be, of course, the shooting star, the engulf, the evening or morning star, depending on the trade direction that we were going with. What other things could you think of in terms of candlesticks that might work out in this kind of location, Toe?
Yeah, I mean, look, you could get a Harami pattern that could work out. Harami patterns are a lot rarer these days because there's so much liquidity in the markets, but Harami patterns can be often very good reversal patterns as well. The Doji candles are obviously very important because they give you a lot of information about what the price is actually doing for that period. But my favorites, and when they do appear, are the evening stars with some sort of confirmation at a resistance or a 20 moving average. When you see them, they very rarely fail. And they're really telling you a lot about what's actually happening at that market at that time. And yeah, they're my favorites for a reason, Tom.
Yeah. So many different candlestick patterns can be used with the lightning bolt strategies. You can use evening stars, morning stars, engulfing candle patterns both ways, and of course, shooting stars and hammers. All right. Well, I think that brings us to the next section, Ty, which is, of course, to get into some charts and to answer some of your questions. So let's have a look and see what we've got here. I'll just quickly load up the platform and we'll have a look at the euro US dollar. And if you want to read out any questions that may be coming in the room, then we'll answer those now.
Sure. Let's have a look. So Rafaro says, practically speaking, using candles only, how do you properly mark higher highs and lower low levels? That's actually a really good question. And we do have a system that that we basically built, which is inside our Ultimate Masterclass, which actually breaks down that process completely, that takes away any ambiguity away from it. So it really gives you the opportunity to identify higher high, higher low sequences in just using price action, actually. And it's very, very powerful. When you understand it, you really, as an example, the chart that we can see at the moment, we can see the Euro USD 2 hour. Again, you can see the last bit of action is clearly higher high, higher low sequences. But to break it down and make it completely bomb-proof in terms of taking away any elements of subjectivity, what you're looking for is series of higher high and higher low candles that don't actually there are a few different ways you can have it. You can have candles that make a sequence of higher highs and higher lows. So basically every candle is creating a new high, and then you get a change in that pattern where all of a sudden you'll get a series of lower highs and lower lows inside the actual pattern. So it probably doesn't make a lot of sense the way I'm saying it, because normally with an example, we can see it a lot clearer. But what it takes away is inside candles and outside candles. So basically inside and outside bars are removed from the equation, and we're only looking for candles that are making a series of higher highs and higher lows. And then when you get a series of inside candles, as you can see right through there, they're discounted. But the minute you've got a series of lower highs and lower lows on their candles, as those two red ones show, that's when you can change the trend. So at the top of that sequence, you can mark that as a high. and the opposite is true for the low. And then what that gives you is a series and a level of H's and L's basically. And when you do that, you can mark them up with a line, and it makes them very, very pronounced. It makes the highs and the lows very, very pronounced.
Yeah, it's basically reading the price from the direct, price itself. So being able to do first time frame, second time frame, and third time frame actual trend reading is very powerful technique. We've done that in exams before, I remember, and it's painful having to do it by hand.
It is.
In fact, they made
it's
you
difficult
draw it
to
out.
explain. It was very difficult to explain in just one little question, actually, because without actually a visual guide, we've got a whole chapter on it in the course because it is a whole chapter. But it's very, very important. It's really taking away inside and outside bars. They basically become discounted. And you're only looking at candles that provide a new high and a new low. And that's what changes the trend. Then you can mark them as a H and a T. So highs and lows and troughs. Good question.
All right. Any other questions coming through, Ty?
Let's have a look. Blake says, useful comment about the time frame pattern there. Thanks, Blake. Yep, very, very important. A lot of people actually discount that. It's very, very important to understand how important the time frame is relative to the movement, because it will change the way your expectation of a trade will go, and it keeps your expectations in check, really, more than anything else. So it's really, really good. So thank you for that.
No, it's very important. All right. Well, basically, we covered anything else. Otherwise, I was just going to say something. I guess I'll say it, and then we'll see if there's anything else. I was going to say that we've covered some great concepts here. Obviously, supply demand is a great concept. Bringing out lightning bolts is a great concept. Candlestick patterns should never be discounted. And when it's all about stacking complements, as we always say on these streams. So just remember, it's about bringing together 4, 5, 6 separate reasons. They have to be separate, and then stacking those little edges on top of each other to create hopefully a much larger edge. And that's what we're trying to get into the discussion for you all today. Now, whether you're trading a 1 hour or 5 minute or a 15-minute candle, pattern or anything like that, just remember, the higher the time frame, the more significance generally it does have. And the higher the time frame you go out, usually your odds will be a little bit better, I've found. And that's just because on small time frames, they are open to a lot more algorithmic noise.
Yeah, most definitely.
All right. Well, thank you very much for joining us today. Sorry about some of the sound issues, guys. That was very strange. I mean, even using a Mac here, it shouldn't really be doing that. But anyway, it did happen, and sometimes those things do show up, but we got there in the end. So hopefully you found this helpful. If you have, please give it a thumbs up on the video. And obviously we'll be back with you guys very, very soon here on the channel with some new content going through, obviously building a complement system. So I look forward to the next topic from all of us here at Pepperstone. Thank you so much for joining us, and we'll see you in the next one. Bye for now.
Thanks, everyone.